This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant. I am the host of the Smart Property Investment Show. I hope you're well. Don't know where you're tuning into me right now, probably driving in your car somewhere. It's actually, I'm sort of spending a little bit longer in the car these days, doing a bit of a commute every now and then. It's not every day, but I do enjoy it because it gives me time to listen to podcasts. I don't listen to property podcasts, though. Occasionally I do. There's some good ones around there that I do tune into, and I listen to it and I steal all their ideas. That's typically the way I go with it. I'm only kidding, but I enjoy listening to podcasts. It's a great way for me to learn about certain things, and I really like digesting information that way, you know. And when I listen to podcasts, I'm sort of quite visually orientated, so I think about what people are talking about and I try and work out what that means or how that would look, or, you know, building blueprints in my brain to try and work out how everything fits together. And no doubt property investment is very similar to you. I'm very conscious that some of the, I've been doing this for a number of years now. I might sort of go over stuff too quickly. So I'm conscious that some of the terms, some of the strategies, some of the principles, some of the doctrines, some of the philosophies that I talk about probably need to dig into a little bit more. And I know people enjoy sort of pulling those threads and understanding. So I will slow down a bit on some things if I think it's relevant, but I keep feedback coming in. Editor at smartpropertyinvestment.com.au is where to send it. The team will pick it up there. And we can go over anything you want. You know, happy to talk about anything, any particular philosophy, if that's what you're into, any learnings, any sort of really strategic stuff or even tactical stuff. And, you know, a lot of people get obsessed with strategy and property. Once you sort of set yourself on a strategy, it's how well you execute it. Those who execute it the best are those that win. You can learn a lot. Go and Google something called the OODA loop if you want. It's a methodology used by fighter pilots out of the US Air Force, came out of the Vietnam War. What they worked out, there was one squadron. There was one squadron in Vietnam, American Air Force, I believe it was shooting down so many more airplanes than the other squadrons who had a loss-kill ratio pretty close to what the enemy had. And they worked out what they did and what was different. And very much it's about this logic and this mindset about planning, briefing, executing, and debriefing. So 4 things. You can apply it to business. You can apply it to your personal life. You can apply it to your relationships. But think about how you apply that to property investing. So planning, what are you going to do? Briefing, let the people know who are involved in it, what you're doing and their role and what they're going to play. Execute, and you need to execute flawlessly. And then you need to debrief. Okay, what worked, what didn't work, let's do it all again. And that particular logic, and it's based out of or similar to the whole notion of the OODA loop, is something put together by an organization called Afterburner, which you may have heard speaking. A whole bunch of fighter pilots who are on the Australian circuit. This guy called Christian Boupacoussis, I know him pretty well. He embraces that and he teaches all over the place. So you can embrace that, plan, brief, execute, debrief. And maybe we can use that as a bit of a way to shape our conversation today. Joining me in the studio, Arjun Paliwal, head of research, InvestorKit. You may know him, and I spoke about ideas that I steal off other people's podcasts. Sometimes it's from Arjun's. How you going, mate? You well?
Mate, I'm glad that those ideas are of value because sometimes I don't hear they're that great when I speak to Lee, my fellow co-host of the Property Nerds, and she gives me a bit of trouble on some of them. So I'm glad that it's working well though, Phil. Thank you.
No worries, mate. I do enjoy tuning into it. You've come so far as a podcaster. You know, it's obviously the Property Nerds is syndicated across the Property Investment Podcast Network where you're tuning into this alongside of Smart Property Investment. Arjun looks at things differently. I'm not a property expert per se. I'm just a guy that talks a lot about property. I am a property investor, so I speak from my shared experience, whereas Arjun and his boffins, and we'll call them that, it's a collective term of endearment for the nerds that sit behind the engine, headed up by the head nerd, Arjun Paliwal, who take a very qualitative approach to property investment. They look at the numbers and they use that to give them clues, to interrogate, look further into places, to identify which areas they should be investing in. Arjun, you've made some good calls. I think last time we got together before Chrissy, we spoke about this, but you've made some good calls. The nerds there at InvestorKit, which are behind the Property Nerds podcast, for some reason are working out the right places to invest. Why do you reckon you get it so right?
I feel like there's a few things, right? Firstly, I've got to give a big shout out to the team behind the scenes. Whilst I can take some credit, it's definitely not all the credit. So very much in terms of how our research division's broken up. We've got myself as the head of research, Anas is our data scientist, Jung is our research analyst, and Larissa recently is our junior research analyst. So in that research division, a lot of chart spreadsheets, that's a starting point. But to take it one step further, Phil, it's bringing out the source of truth and going on the ground. So when you combine a macro understanding with data points that are the end result of those drivers, and then end up actually looking on the ground at many parts of the country to say, hey, this is starting to play out, or that article that was out there isn't true based on this. It just gives a lot more confidence rather than just sitting behind a screen all day.
And you like doing it as well.
Yeah, that definitely helps, right? So I think...
is that what you do on a Saturday afternoon when everyone else they go, I know you like your basketball, but you sit and go, I'll just go and look at some spreadsheets.
Yeah, and that's a normal day and that's a normal weekend, but not for many.
Yeah. And there's been some data come out recently, and I think it's validated a lot of your calls a year or so ago. I think realestate.com sent out some stuff recently, and a lot of the areas that you identified and started buying in some time ago performed pretty well over 2022. Can you tell me about some of them?
Yeah, so Real Estate PropTrack, also known as realestate.com.au, released some data on some of the top 10 performing SA4 areas. So for any technical jargon, essentially it's a big region, and that region can either be full of a couple of cities or at least a couple of councils. And so that is a statistical area that ABS uses for their measurement. Instead of just saying the city's name, they just make it harder for you and say, some other region that has that city within it. But long story short, they created a top 10 of performance. So this wasn't a prediction for 2022. This was January 23, looking back on the actuals of 2022. And firstly, I think many were surprised that that whole list was double-digit capital growth, which I think surprises many by the narrative of obviously rising interest rate, price declines, and low sentiment, which is definitely rampant in a few other cities. But that's the beauty of investing. You don't buy a house that represents all of Australia. You buy a house in a micro location that's part of Australia. And so I think that's a big part that we really applied in our logic. And when we broke down that top 10 list, 9 of the top 10 locations were locations that we had either actively made public calls on or are investing in for our clients even prior that booming period. So just to name a few, the Riverina region, places like Wagga, other regions, most of that region was dominated by sub-regions of Adelaide, which was another call I think you recall us making about it being the top performer for capital cities for 22 and to grow double digits, which it did. And then lastly, there were other micro regions like Bundaberg, Toowoomba, Hervey Bay, these sorts of surrounds. So I was feeling very, very excited to see that list once I saw it. And the outcome of it was definitely a massive change of wealth for many families, but also just gives us confidence, because when you have not 1 year, but going back to 2017, from Burnie, Tasmania to 2018, regional Victoria to 2019-20 Adelaide, and then picking out the recovery of places like Sydney. So these things just give us confidence to go, hey, we've really found the right solutions to help investors. Now it's just about, hey, how many more can we help and how many can we get to the end goal, not just a property market research goal, but an actual end goal of passive income. So that's very fulfilling when you hear that sort of stuff.
Yeah, and you're obviously leveraging data and the lens through which you choose to view data. And data's information. It's about how you interpret it, and the action you take from it is, how people use data, market intelligence, business intelligence, whatever you want to call it. But I'm a journo, so I've got to prod and push sometimes. And you said you made these calls. Other people made those same calls, Arjun. So what is it do you think about the way in which you determined these were investable locations, and what did you get that no one else got?
Yeah, so the first thing is sometimes when you have a lens that's quite close and tight and focused on an area that you've gained either familiarity with, comfort with, or you truly believe in, the sad news about that is that the lens doesn't spread out further. And so you get this bubble, and that bubble in your mind might be Sydney's the greatest thing of all time since sliced bread, or maybe it's Brisbane, or maybe it's Perth. And this story you tell yourself doesn't allow you to spread wings and start to see what the rest of the country has. And I think that's the biggest fundamental shift that we've applied in comparison to others that may not be making those correct calls, which is, hey, let's take a stock take of the whole country. Because if we remove that bias, remove that love affair with a certain city and start to look around, we start to just pay attention and acknowledge those trends. That's the core fundamental, firstly, Phil. But then when it comes down to it, the most simple thing is too many people look for the drivers, not the outcome. And that's one thing I've learned in property research, that I might feel the driver is population. Ask a friend at a fellow barbecue, and the barbecue is always a good example. They might say, no, it's the jobs. And someone else might say it's just an all-round great place to live, or it's a great location to visit. And we get lost in the reasons, and we feel like if we can't bring a reason to life, we can't bring that location to life. And so what really differs for us is that we focus on the end outcome, which is a scoring, various indicators, various things that are source of truth that say, are people fighting for homes or likely to fight for homes? Or is it a whole lot of not much fighting going on, and it's just everyone's reasons of why, not so much the end outcome, that the core data points seem to change.
So, you're very data-led, and there's a number of different ways you can use data. I spoke about how you use data to form a view and then you take action on that view. A lot of people try and use data to prove a point, whereas other people fiddle around with data to extrapolate information, and two very, very different things. And what I find most property investors do is that they have a feeling, they have a gut instinct, they have, someone told them something, and they'll go away and they'll use data to validate a view that they have. And that can be hugely dangerous. So how do you and your team fight bias, and whether it's known bias or unknown bias, from going into it completely open to what an outcome may be from how you've chosen to slice and dice the data up? Are you aware of the biases and you are able to combat or fight them?
Huge bias. It totally exists, right? And I remember going back to my academic days and the old, MBA that I was doing back in the day. I think I recall two different subjects writing about the same company as a case study. However, I just wrote about one on the for and one on the against, and both passed, Phil. So the key is that the world rewarded me in saying the same company was a for and the same company was an against, using two different subjects, sure, but the directions were completely opposite, and yet I was rewarded with passes because I used data to back my picture. So you just nailed it on the head there, which is the biases do exist. And so the biases tend to exist because people have grabbed that microdose of information, that starting point. Hey, someone said Brisbane's great. As a result, I'll look for all the information for it. Or the Olympics is the most common one. The Olympics is in my head, and now I must find every data point to make it so that the Olympics is going to be a successful journey for property investing in Brisbane. Yeah. And so the key here is to take that step up.
Yeah, so if you hear me talk about something, go, oh, yeah, Phil said this is a good suburb, I'll go and prove that it is or isn't. Don't do that.
Definitely right. So
don't do that. Don't do that.
Don't do that at all.
Go to someone that knows what they're talking about. But you got to be aware of these biases, because it's okay. Like, it's okay to have biases. Like, it's a natural human instinct to have a bias. But just be aware of those biases and understand when a bias may be negatively influencing what you're doing. And we're talking about property data, but this absolutely everything in life, right? But be aware of those biases. And just if you have the consciousness about it, the biases can be an enabler if you are aware that they are there. But how have you sort of changed up your research protocols or research doctrine since you kicked off InvestorKit? It must have got a lot more sophisticated as you and your team have expanded out your data sets. New data sets have come on board. Artificial intelligence empowering the way in which you can use data now. It must be chalk and cheese, even sort of 3-4 years on, Arjun.
Yeah, I've had a lot to learn. And one thing that many people won't admit as much is how much you can learn on the journey, not just how much you've tinkered and all the fancy stuff that's happened. What I have come to learn is that the markets that have a strong backing of local economy just have popped off a lot more than those that haven't, even if the data points on the indicators looked fairly similar. So to simplify that even more, you might look at, oh, I like this place because it's selling faster. There's more sales volumes, or there's, a good vacancy rate, and all these checklists that you go through ticking. But if you can't interpret or understand that local economy, figure out what's driving it and also where it's heading or likely to head, I feel that was a big learning I've taken over the last few years, that economic side of the story. And I'm not just looking at unemployment, I'm looking at it from unemployment, job advertisements, industry composition, infrastructure in pipeline, what type of infrastructure, social, roads, actual buildings, and other things. So these sorts of things have played a lot more impact in my analysis. But the second thing I'd give a lot more weighting to is actually scoring markets and looking at that whole country lens. Now, one thing that you pointed out was the bias that exists in market research, and that tends to start from that one piece of information you get, and you go down the rabbit hole and spiral through trying to figure out what's happening there. Whereas when I started looking at a mixture of indicators and the story needed to be positive for a market for us to onboard it, we then use this whole idea of, wait, let's benchmark across the whole country. Let's score. Let's apply machine learning, AI, try and look back, look forward, and try and think of the whole country as that starts. And so doing that made us realize, well, yes, I'm excited about this Olympic opportunity here, but this place over here seems to just tick, tick, tick on so many more points. And then that really made me appreciate the whole removal of the bias piece, which was, if I'm not going to get a healthy economy to back it and push it in the right direction, and if I'm not going to have this benchmarked across everywhere to make my opinion fair, then I'll be guilty of those mistakes of telling myself a story and, seeing it come alive. So I feel that's where the two biggest changes have come from. But the third part, which I think many struggle with, is the openness. Like, how will you genuinely be open to a city that you might not have ever heard of before, visited before, or have a lot of people in that city? And that's a very challenging thing because, if you're doing this research sitting in a big corporate tower in Sydney or Melbourne, or sitting in a beautiful beachside location in a multi-million-dollar suburb in Perth or wherever else, and you start to see the indicators and everything work well in a town of 30,000 people, and it just seems too small, doesn't work, doesn't make sense, or a town of 100,000 people, and you can't just get comfortable, you leave a lot of opportunities on the table. And I feel that being open to Australia and recognizing that opportunities all around are going to do well, considering CoreLogic reported that the last 20 years of housing data, 90% of local government areas for houses had 5% or more of compound growth. So if you trust in the long term, you should be as open as possible because the data suggests that the long term you'll be okay.
Well, that's the idea with property. Arjun, we're going to go to a break. When we come back, we'll pick that up, but also want to get some key trends from you. Stay with us back in a moment. Welcome back, Phil Tarrant, host of the Smart Property Investment Show with Arjun Paliwal, head of research over at InvestorKit. Now, Arjun, a couple of things I want to run through, but beforehand, a bit of myth busting. All property markets in Australia are losing value rather than growing in value. Myth or fact?
Myth, my friend. It's definitely a myth. And the fact that, we could make multiple states have top 10 growth, trends of each relevant state, and the majority of those top 10 lists would be filled with double-digit growth across many micro cities. That just shows that there's a lot of growth still happening. But of course, there's also some areas still declining. So that's probably what's, definitely clouding. And the biggest thing I share with all fellow data folks out there, or those who wanting to get keen into it, is the concept of statistical weighting. And that essentially shows that some of our biggest cities carry the biggest weighting of the data for Australia. And as a result, the national picture isn't looking pretty right now.
Thanks for telling us that. And sort of while we're chatting about it, have we yet seen the impact of these interest rate hikes that we've seen recently, or is there all the pain or the pent up pain of hiking them 3+% still to be seen? What's going to happen?
A lot of it we've seen because with interest rate changes, yes, I know that the big question for many is there's a lot of fixed rates that haven't felt the change. But one thing we have to realize that housing involves people, involves emotion, and involves a whole bunch of owner-occupiers. In fact, 65% on average of Australia's dwellings are simply that, people living in it for the purpose of shelter, not having some paper stock that they're trading. So why that's important to point out is that if people anticipate changes, they're not going to be this statistic on a spreadsheet that just sits there until their fixed rate expires and then suddenly go, oh, I'm dead now. Like, just because the stat said so. No. As humans, we see things, we can have rates increase. They didn't all increase in 1 month. We had 9 increases over the last 10, 11 months. And so as a result, this is where many people may have opted to maybe rejig finances, restructure, refinance. And the data says that. We're in a refinance boom, Phil. It's the biggest refinancing that we've seen in history, really. And a lot of that's happening right now, even though lending is harder to come by, even though borrowing capacities have dropped. People are still refinancing at huge amounts, which clearly shows that there's a level of proactiveness on their finance management. There's buffers. But of course, there are a lot of unfortunate families who have felt and are likely to feel more pinch as fixed rates come off. However, in terms of the worst, I do genuinely feel from a perspective of actual housing declines in the cities that have seen declines is actually behind us. Now, that's all based on interest rates not forever increasing, because the trend for many is probably feeling like that when you just see that meeting each month and they don't tend to stop. But I think it's clear to say that the tone is changing and the numbers will need to change, because if they go on the same pace for 2023, then the picture isn't pretty. I just don't think they're going to be at the same pace for 2023. And by they, I mean the RBA.
Yeah, I get all that. I think pretty well observed. And I know this is a podcast for property investors. So these are people who are proactively taking action to create wealth through property. But I certainly acknowledge a lot of the hardships some quarters of Australians are facing with hiking rates. It's tough. It's tough for Australian families. It's tough for those with mortgages. And I think a third of all property has a mortgage against it by memory, maybe a bit more. So fortunately, running off COVID, family balance sheets were strong with savings. People ahead of their mortgages. So people have been chipping away at that to help buttress some of the increases in interest rates, and that's a good thing. But belts are starting to tighten. And for property investors, be proactive, speak to your mortgage broker, get your stuff done. You should be able to navigate and move through it. Arjun mentioned the boom in refinancing. That is proactive people making sure that they've got the best mortgage for what they're doing right now. On the other spectrum of that is some people who are really hurting, Arjun, and our thoughts are to them. Different situation, different podcast, perhaps. I want to get back to, but I sort of spoke about it, and I was completely off the cuff at the top of this podcast, but I was sort of thinking about it because you are sort of research orientated in the way that you buy, and you use a lot of structure and the scaffold of process and theories in order to assess different areas. Now, I spoke about this thing called the OODA loop, or a version of it, from this organization Afterburner, which talks about this guy called Christian Boubacoussis, ex-F-18 fighter pilot, tornado pilot out of the Royal Australian Air Force. Now he sort of talks about this with business owners mainly, which is plan, brief, execute, debrief. It's a circle, round and round and round. It's a methodology for success in business. But as I said, you can apply it to anything. So I want to apply it to property investment while I've got you here, because the way your brain's wired as a methodology, I reckon we could probably give a bit of a lens to it. So let's chat about that for a little while. Plan, brief, execute, debrief, repeat. When it comes to property investment, what's the planning bit?
Yeah, the planning bit in the property investment is actually just 2 steps before the research. It's portfolio planning and finance. And the old quote of, I think, housing's a game of finance with property's a game of finance with houses thrown around, right? So I don't know if I've actually botched that quote, but I just definitely know how important finance is. So sitting with people like your broker and accountant to get that finance plan right is where we all start for successful property investing, and then move on to the actual portfolio planning. Many people will throw out the most commonly said numbers, which are 100 or 150K for passive income, and then work out that their aggression, their risk profile, their monthly savings, their borrowing power just don't allow them to hit that. Or they think, hey, that number works, and then they do it and realize that they could do it in 10 or 15 years versus 20 or 25. So the key part is, before we get into planning property, it's actually all planning. And that plan piece is portfolio and finance as the most important pieces before we move to location research.
Okay, so what's the briefing part of it then? So plan, brief, execute, debrief. What's the brief?
Now that the brief is set in terms of what the end goal is from that plan, what the risk profile is, what the savings per month is for that person, how frequently they're going to be buying. Now we move into that brief in terms of, okay, we've got doc points. Do we have a research methodology, a research process? And of course, the team to support you. In our case, Investigate Buyers Agency, doing that for clients. that's the brief collection and almost the brief application before we move into executing.
Yeah, so it's making sure everyone knows what they should be doing at any given time, and they understand exactly what the plan is and what the outcomes of the plan is. And that briefing, it's tough to do it alone. And I'll tell you what, no property investor acts or operates in isolation, even if they don't use a buyer's agent. They've absolutely got an accountant. I don't know too many cash buyers, so they've actually got some sort of finance engine behind them. They don't normally do it in isolation, and normally got a partner, a wife, a husband, whatever. So you need to make sure the family knows what's happening and where you're going and why you're doing it and what you're doing. So the whole briefing bit is important because it allows you to get people to buy into what the plan is and making sure they have some ownership, some sort of interest, or at least some understanding of what the outcome is. And at that point in time, they can question it or query it, or they can go, hey, that sounds really good. I'm along for the ride. How can I help out? So the briefing part is really important, but the execution bit, and Arjun, I see people do this all the time. They start at the execution, and then they go back to the planning and then the briefing bit, as in, I just bought a house. I don't know why I've done it, and no one knows about it, and now I need to try and find a mortgage. So one of the biggest mistakes I see property investors make is that they start at the execution when it should be after the planning, after the briefing, and at the execution. But you get the execution right. So this is in your business, Arjun. After all that hard work about understanding the who, what, where, when, how, and then you go about, that's when you find a property.
Yeah, spot on. Because if we're going property first, you're just applying the Band-Aid solution, right? You're just starting to patch things there, and you also get rattled. And that's the thing that many people stop investing with, is a rattling to their confidence or ability to act again and again. Because most of the successful plans in property investing usually have multiple purchases, holding for a long time, and either some sell-off or pay down of debt, right? And so from that perspective, if you have a bit of bad news, whether it's media, whether it's your local friends, or whether it's just something that you heard in the local area, all of a sudden you're going to be rattled a little bit more because you've got no plan, you've got no structure, you've got no team around you that you're going to. And so spot on, this is where the execution needs to happen after all of that, and needs to happen with that approach we talked about, from really having the whole country being looked at and then going down to that data in the micro and even on the ground to make suitable decisions.
Yeah, and it's about flawless execution. It comes back to this fighter pilot methodology mentality. They execute flawlessly, like I can't remember what it is, like 97 point something % of the time. And the reason why, if they don't, they get shot down and they're dead. But seriously, like this is where this methodology comes from, because when you look at people who execute flawlessly in their job, like they're way up there. They're up there. I'd say doctors. You want doctors to be pretty good at getting it right in their jobs. Some other jobs like podcasting, probably a little bit more forgiving. But this is a flawless execution, time and time again. It's a doctrine they have. And then the debrief is important, because only then you can work out, did you do the right stuff and what do you do next?
And in a way, we're debriefing now, right?
Yeah,
because we talked about at the start.
Yeah.
This is debriefing. We talked about, hey, what are the calls we made in 22? How did they fare? What are the calls we made back from 2018, 19, 20? How did they go? And spot on, the debriefing is so important, because those models that we built don't evolve. Our team of research doesn't evolve, doesn't change. The outcomes won't change for the better unless we debrief, stock take, annual bank valuations, multiple data sources to see what the actual outcome was versus what we thought the outcome was. And sometimes even taking a moment to stock take and go, I was wrong with this one. Could have been better here. Rather than telling yourself that story that the data bias can do, which is, hey, it's time. And the perfect it's time moment is going back to the old 2012, 2013. I can remember going back that long. I was in the CBA days working at the bank there, and every other person was saying, Brisbane's going to be the spot. And there was some that reflected and said, hey, you know what? It's a great city with long-term fundamentals, but maybe I just realized I got in a bit too early and things didn't go so well for the next 6 or 7 years. Eventually, those who held on obviously look back and go, phenomenal. It's done some performing now, but I'm sure a lot of people would have loved to have been in Sydney and Melbourne during 2012, and then maybe some other locations in 2017. And then the clock turns around and they come back to Brisbane in 18, 19. So I just want to make sure I'm often remembered using this framework you've given as someone that debriefed and said, we were good here, we were okay there, and we could have been better here. and adjusted and got better, rather than someone said, no, it's going to be Brisbane's time for 9 years before it actually happens. So that's the big key on debriefing, right? Taking accountability.
Debriefing is cool. And I think I was probably one of those people like got into Brisbane early and nothing happened for a long time. I was going, what's this, right? But it's been good. But what we're talking, this is a really, really simple framework, like really simple framework, embrace it. And I hadn't really thought about it in property before. I don't know why I started talking about it when I started chatting, but it's just simple, plan, brief, execute, debrief, just keep doing it. And debriefing is good. It's fun. Staying on this idea of fighter pilots, you must know the Blue Angels. It's the US Navy's aerobatic team. You would have seen in the blue jets that fly around. After every single air show that they do or every single display, they debrief. It's part of their doctrine. They debrief after every single time they perform, and they have a thing, they call it nameless and rankless. So they'll go into a room, all of them, and one of them might be a colonel, another one might be a lieutenant. Doesn't matter who they are or what rank they are, they debrief without any bias whatsoever. So it's at that point in time when a junior person to a senior officer would say, I saw you do this, that was not right, you should have done it like this, you should do it better the next time. And they do that, and they've embraced this idea of being nameless and rankless. So it's not about who did it, it's about what happened. And how do they collectively improve? It's culture. Comes to culture, and you can embrace that.
That's powerful, Phil, because now I think about it, I can remember, and look, I'm young in my learning in business, and I find that there can be multiple meetings where it feels like you're in that room talking and it's just you or maybe a couple other folks, but then there's a whole bunch of new people who've come in and they maybe don't feel comfortable to have their voice out there. And that's just a perfect environment to have if you can get a company or your property team or your own sort of circle of influence of friends around you where you can all just be honest and upfront with each other. And speaking of aviation, my knowledge probably doesn't go as far as the Blue Angels. It maybe cuts off at about Top Gun 2.
Yeah.
And how good was that movie, by the way? That was phenomenal.
Yeah, no, it's very cool. But you can embrace that, this whole nameless and rankless. They structure it so they say, okay, this is the point where let's go nameless and rankless. But then, that's part of their culture. But in business with your property team, you sit there, your accountant, your buyer's agent, your financial planner, your broker, yourself, and everyone else and go, okay, what's going on? Listen, we're not here to blame people. We're just here to work out what we've done and what we can do to improve it. And you find that through that perpetual learning, people improve, and it just becomes a cycle of really positive culture. So anyway, why we started talking about this, I don't know. I apologize to all those people going, well, what's aviation got to do with property investment? What we've just done, though, is apply fighter pilot methodology around high performance into property investment. So what I might do, I might get the guy who I spoke about, Christian Bukhusis, to come in and do a chat with us to next time about this. I know we invest in property as well. But anyway, just that's applying one structure, one methodology to property investment. Maybe we can do some other ones moving forward. Maybe there's some sort of medical methodology they use that we can give a property investment sense to. We're going to go to another break. Stay with us. Back in a moment. Welcome back. Phil Tarrant from Smart Property Investment, having a chat with Arjun Paliwal from InvestorKit. Now, Arjun, and sorry for boring everyone for that last bit, but I think that, this is a good methodology we spoke about. I want to talk about sort of three trends quickly to consider for this market moving forward, which I think we can rightfully say we're towards the top end of this interest rate upward cycle. I think we can agree to that, maybe 1-2 more to go. So we can proceed with making some decisions around that. And I think most economists are pricing in maybe some rate reductions next year. I don't know, but there's got to be a sense of stability moving forward. I think it's fair. So what are the three key trends to watch?
Yeah, look, Phil, the first one is definitely on the part that is massively being seen across the country, and that's the rental markets. We're seeing queues and lines just get worse and worse all over the country for open homes. We're seeing people test dollar values for their investment properties at substantially higher amounts and still get it. And so the first trend to consider is that this problem isn't going away anytime soon for renters. And from an investment property owner, rents are likely to continue to rise. And some of the data behind it is that we're operating at just over 50,000 rental listings in the country right now for rent. Now, if you take that back to 2016, 17, that was about 106,000 at its peak. Now, the big thing to note, Phil, is that between 2012, when it was just over 60,000, it climbed up to over 100,000 with a boom in two areas. One boom was investment lending, so there was more total rental stock in the pool. And the second boom was dwelling approvals of all types, detached, attached. So there was more stock being created. And since then, the 2017 saw many changes both in finance policy and supply approvals. Now we've seen that trend go down and then go even worse come COVID. And now we're at some ultra low vacancy rates with the borders open. Rents are going to get higher and higher. And what's going to stop them from getting higher is a couple of things, either major policy shifts that makes investing more friendly, more attractive, and more investor lending goes out there, which obviously also needs interest rates to play game. Other things could be more development pipeline coming to fruition and more institutional money coming into the mix, so larger projects for rent or build to rent as we know it. But then another component that's not considered is that we may see a lot of family formation switch. Maybe mates sharing a property, multiple couples sharing a property, a whole family not moving out as frequently. We saw that trend, make more households during COVID, but could that trend reverse because of the rent prices moving at huge amounts? So that's the first trend I would say it's quite apparent, Phil, at the moment.
Okay, second trend?
The second one, this is actually about the recovery in our major cities that felt a decline. So as we know, we saw interest rates increase a lot, and we saw a few of our big cities decline in prices. The things that stood out to many are likely the declines in Sydney and Melbourne and even Brisbane and how quick that pace changed. There were many other major satellite cities surrounding these big cities that also declined too. But with these declines, many people were expecting a huge surge of property listings due to the increasing cost for households. Well, the thing is, that hasn't happened. Listings had some upwards trajectory, but they've come down over the last few months and are remaining at some pretty low levels. So there's approximately 215,000 properties for sale across the country. To give you some context, if you wind the clock back 5 years to 2017, around the same time, there was over 320,000. So there's still 100,000 less properties for sale on the net across Australia, even though there's a whole lot more people here in the country. And there's a whole lot more cost of money, less lending, more interest rates. So I think the key here is that the recovery, or as you pointed out, that sort of floor or where interest rates might end, I think that's one component of it. But right now, the supply has not been coming to the market to flood it. That would suggest that we have a lot of households in good position, which is fair considering balance sheets, repayments ahead, job advertisements, unemployment. It just means that those cities that have seen a little bit of that backwards movement are likely to see a recovery this year, pending we don't see out of proportion or out of forecasted interest rate rises that just keep hurting households, both for finance take-up and their balance sheets.
And then I imagine the last trend's got to be somehow connected with finance.
Yeah, this third trend is all about finance policies, rates, these sorts of things, because as we know, whilst they aren't everything, they are a key part. If you drew lines across Australian property prices and put a finance line overlaying it in a chart, and if you pause that finance line by 6 months because people will take longer to make those decisions from finance, settlement timeframes, and so forth, the lines are practically on top of each other, which means that finance is the controller of property. And as you said a lot in this episode, not a lot of people running around buying houses with cash. So I think from that finance perspective, there are 2 to 3 big changes to look out for. When do interest rates start to reach their top? And I'm of the opinion that we're very, very close. And I think on earlier podcasts, I even said that late this year or early next year, we may see some declines. And just recently, overseas markets across, say, the USA as one example, are predicting much the same for their local economies. And as we know, whilst not all money's connected, there is a small connection between all these other countries because of our imports, exports, the dollar, and so forth. So when we think of our funding lines too, I think the finance side of things from a policy perspective had some fantastic policies to protect us a few years back, and that's the change of assessment rates. So assessment rates for those new to the term is basically banks saying, hey, you might be getting lending at 2 or 3% back in the day, but we're going to assess you back then on 5, 7%, which I think was a brilliant move, by the way, Phil, because how good must households be feeling right now that when they got that 2 to 3% money, they were assessed by the bank as if they were on 5, 6, and 7%, which is where we are now on the 5s and where we could be heading if they keep going up. And yet households were assessed on that. So it's very important. But if those rates keep going too high, then that assessment rate has two issues. One is if you're having 5% rates today, you're now being assessed on 8 or 9. I just don't think that makes sense, because whilst that was a very positive policy for protecting Australia in the 2s and 3s, so we get back to those long-term averages of interest rates, but when we're in assessments of 8, 9, 10, the whole country would explode if we had 9 and 10% rates today with the amount of debts we have. So it's actually less productive for Australia's economy, Australia's households to refinance and find what's best for them. And it's actually better for the banks just for them to be stuck there and not move as much. So I personally think that there could be some movements in assessment rates if the finance numbers for interest rates keep going. And of course, interest rates may not increase towards the tail end of the year, could even decrease. So that's our thinking on that side.
I tend to agree with you, Arjun. And you're talking there about APRA, the prudential regulator. A lot of people get annoyed with APRA when it brings in all its different changes to how essentially they give the rules in which the banks need to operate within to do lots of things, but we're talking about specifically around mortgage debt. So, when APRA said to the banks, stop lending to investors, or you've got to change your blend of your book, so less investors, more in occupiers. A lot of investors get stuff, you're stopping me from doing stuff, but they put these policies in place to proactively, and they like to think positively, shape the market in the right direction. So they did that. It was okay. Brought back investor lending a fair bit, had a consequence impact on property prices. It was all about sort of affordability for Australian owner pockets to get this stuff. And then, applying this, it went from 2.5 to 3%, if you remember. APRA said this margin they need to stick on top of mortgage rates, pretty much going, yeah, you might be able to afford a mortgage at 2.5%, but you need to be considering paying that mortgage off at 5.5%. So they put that in, which curbed a lot of people's serviceability, and they complained and moaned about that, but there's very good reason why. So APRA is a body for giving the rules, and this is really simplistic, but giving the rules and regulations for how banks operate and lend money to consumers has been hugely positive for Australia. Hugely positive for Australia. It's helped buoy and sustain our property market. A lot of people globally look at the Australian market and point fingers at it going, it's a bubble, it's going to burst, there's too much debt compared to other parts of the world. It's a very different market here. However, those things through APRA is good, but I do agree, and I know they're talking about it, or there's getting banded around that, they will start to bring that sort of buffer down in line with interest rates going up. So something for us to talk about in the future. Arjun, good chat today. Covered lots of ground.
Mate, it's a deep chat, and I've left with a lot of frameworks as well on the aviation side of things. And I think it's just the most important part is the debrief, right? We've debriefed, and I'm just looking back and seeing some of the impacts that many have had in a positive light from the forecasts and predictions we've made over 2022. And I'm excited for 2023 in terms of, the investors on the show listening, what that brings for their portfolios, both from certain rental changes and also from price recovery. And of course, if you find the right markets using research like we do, more price growth.
Yeah. Look, embrace debriefing. In many ways, podcasts are just debriefs. That's what it is. What's happened and what do you do about it? What's going to happen in the future? What do you do about it? It's good. All right. Arjun Paliwal, Head of Research InvestKit. Thanks for your time today, mate. Really enjoyed it.
Thank you. Cheers.
Nice one. Remember to check out smartpropertyinvestment.com.au. If you like this podcast, whichever player you tune into it, please keep the reviews coming. We get a kick out of it here to know what we're doing is working for you. Any questions, editor@smartpropertyinvestment.com.au. Email the team there. We get into it. Social media, Smart Property HQ, if you want to know what's going on, and make sure you are aware when every new podcast comes out. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.